Good morning. 1031 exchange explained and what can go wrong. So, if you own investment real estate in Houston, Katy, Fulshire, or anywhere in Texas for that matter, a 1031 exchange can be one of the most powerful wealth preservation tools available. But here's the honest truth that most owners don't get a chance to hear. And a 1031 exchange can increase your portfolio or permanently damage it, depending on your execution. So let's talk a little bit more and go beyond the basics and figure out what could actually go wrong in a 1031 exchange. So, what is a 1031 exchange is a good starting spot. And the 1031 exchange is named after Section 1031 of the Internal Revenue Code. And what it does is it allows investors to defer capital gain taxes by reinvesting the proceeds from the sale of one investment property into another like kind investment property. And instead of writing a six-figure check to the IRS, you're going to be able to redeploy that equity into a new asset. And used correctly, it's portfolio leverage. But used poorly, it's forced reinvestment under a pressured timeline. So let's look at the three biggest 1031 exchange risks. First being is timing traps. You have a 45-day and 180-day clock. So the moment you close on your relinquished property, two clock timelines are in process at that moment. And you have 45 days to identify replacement property, and then 180 days to close on it. And there are no extensions, except in rare federal disaster declarations, but don't count on it is the point. And what goes wrong? Sellers close without a replacement strategy, or buyers overpay due to deadline pressure on them because of the exchange. And that could result in poor quality assets getting identified just to meet rules, or financing delays can blow up your 180-day window. And I've seen investors sell strong performing assets in Katy and West Houston only to rush into weaker properties because the clock has forced their hands. And discipline must start before the sale is the point. Two is replacement property risk. And many investors focus only on tax deferral, but not on asset quality. And that's a dangerous concept. So let's look at some common replacement errors. Number one is overpaying to make the math work, or ignoring tenant rollover risk, or underestimating deferred maintenance in a property. But also potential weak lease structures versus maybe a modified triple net versus a true triple net obstacle, or buying outside your operational expertise is another area. And remember, the IRS doesn't care if you bought a bad deal. It'll still work for them. But the tax deferral does not equal investment performance is the bigger point, and that should be your goal. So a 1031 should improve your cash flow, your asset quality, your location strength, and your tenant durability, but also your overall portfolio structure. And if it doesn't improve at least one of those checkboxes, you're trading stability for tax deferral. And what's that really worth? Three, when not to use a 1031 exchange. And this is where high-level strategy comes into play. And a 1031 exchange is not a mandatory thing. It's completely optional. But sometimes paying taxes is the smarter move. You may be asking yourself, why? Well, situations where a 1031 may not make sense. Here you go. So you want liquidity, so you're actually looking to cash out, or you're planning to reduce your real estate exposure, or you're transitioning from an active to a passive investment, or estate planning via step-up basis may be a better strategy. And market pricing is irrational and replacements are weak. It could be another reason. So in today's Houston area submarkets, we're seeing compressed cap rates in certain retail and medical assets. And if you sell but you can't buy smart, then the exchange traps you into mediocrity. So the tax deferral should serve your strategy and not dictate what your strategy is going to be. So let's look at some other critical failure points. Choosing the wrong qualified intermediary. Let me know and I'll connect you with somebody great. But funds must go through a legitimate QI, and mishandling funds can invalidate your exchange. Or improper identification rules. Now you must follow either the 3 property rule or the 200% rule or the 95% rule, one of the three. And mistakes here will void your deferral. Nobody wants that. So let's look at some debt replacement errors as a problem. So you're going to have to replace with equal or greater value and equal or greater debt, or you have to bring cash into the equation. Otherwise, taxable boot is triggered, and that's something you want to avoid. So let's look at some strategic 1031 planning framework. And before listing your property, you probably need to ask yourself, what is my long-term portfolio goal? Do I want more management or less, active or passive? And what's my capital stack tolerance? Am I going to bring in partners or investors, or am I doing this all on my own? And also, am I upgrading the asset quality? And also, what happens if I don't find a deal? Well, we need to start earlier in the process for that one. But this is exactly why 1031 exchanges must be coordinated by a few parties. So you're going to need your broker, you're going to need a CPA, you're going to need a qualified intermediary, and you're going to need a lender. And a well-executed exchange is structured and not reactive is the point. So let's look at some Houston and West Texas market considerations. So in growth corridors like Katy, Fulshire, Brookshire, and Richmond, we're seeing some retail fundamentals remain strong. Industrial demand is stable, and medical office continues expanding. And there's older office product, and that could carry some leasing risk. But we're seeing suburban perform better than urban right now. But this means that your replacement selection is going to matter more than ever, is the point. So let's put it all together in focus. And a 1031 exchange is not just a tax strategy, it's a portfolio restructuring event. And if you do it right, it compounds wealth. But if you do it wrong, it's going to lock you into a weaker real estate for years. So if you're nearing a disposition and considering a 1031 exchange, structure it before you sell and not after. So here's my ask for the day. If you're thinking about selling an investment property in Houston or surrounding markets, let's map out your exit strategy and your replacement strategy before you start triggering the 1031 exchange time clocks. And that, my friends, is it. My name is Bill Rapp with the eXp Commercial Viking Enterprise Team. You can visit my website at HoustonRealEstateBrokerage.com and figure out how to get a hold of me directly. Love to talk to you in person. Have a good day.